Hi, I'm Jimmy. In this video, we're looking at the stocks that I'm most interested in buying. I actually call this list my bullpen of stocks. And essentially, when I do research on companies, I try to do deep dives on different companies. And as I analyze the company, the question is this company a company I would like to own at some point? Perhaps not at this price, but at some point I'd like to own it. What I do is I ultimately put together a bullpen of stocks that I sort of watch and monitor to see where I want to buy them. Now, for this video, we're going to go through the different sectors. We're going to break the entire list out by different sectors. We're going to talk quickly about why each company is on the list. Although I did do a deep dive on each of these companies. So if you're curious to know more about any one company, we have videos on each of the companies. Then we're going to touch on what the fair value is for each stock, as well as the ideal entry price. To come up with the ideal entry price, we actually add a margin of safety based on the research that we've done. And then that's how we go from the fair value to the ideal entry price. You'll see it in a second. Okay, so the first sector we're going to look at is actually a sub industry, and that's communication services. Within the communication services, I actually have 5 different companies that I like. All 5 of these I actually already own. And I recently did a video on my portfolio. So if you're curious about my entry prices and which companies I own and how diversified my portfolio is, you could see it. But just know we're going to put a check mark next to any company that is in the bullpen that is also in my portfolio. And ideally, basically, it gives me a reason to watch it and see if I perhaps want to average down my entry price if the stock keeps dropping. For example, Disney. Disney right now is trading in the low 80s. I have the fair value up near 100. It would make sense to buy that one and drive the price a little bit lower. I'm probably not going to, just because, limited capital, all those things. I have a limited amount of capital and frankly looking to diversify my portfolio in other directions. But a company like Google, which is currently trading above the ideal entry price, well, I'm less interested in averaging down at the current price. Now, if you're curious why I have all 5 of these companies, well, these are all 5 companies that I've researched in the past that have looked good and I wanted to buy, but not until like 2021, 2022, when the stock market really pulled back, did we get the opportunity. We got a lot of these opportunities near each other, so I jumped in and bought pretty much as many of them as I could. Now, the big thing to pay attention to, at least one of the things that I pay attention to the most, is the column MOS. MOS is short for margin of safety. The bigger the number, the more risk I believe there is. Frankly, the only one I'm questioning on this list right now, as far as margin of safety, is Disney. Although I love Disney, I love their brand, I love what they're doing, there is a bit more risk than 5%. 5% is the minimum I will do. Like Alphabet, Google, I think is super solid, has a big moat, has a strong brand, does a whole bunch of different things, solid growth, all of that stuff. So I don't need much of a margin of safety. A company like Meta, at the time when I bought it, things were tumbling, numbers were in question, they were pushing their whole VR headsets, all of that stuff. I had some added question marks there, so I had a bigger margin of safety. Since then, of course, that stock has recovered nicely for us, but that's how I do it. When I do the research, based on the risk of the company, Warner Brothers Discovery is on the list. They were part of AT&T. They spun off, and Warner Brothers is, revamping their business. They're building a whole new platform away from the HBO platform and creating a whole new one. There's a certain amount of risk with that, so I have a higher margin of safety. By the way, 25% is my highest margin of safety I will use. In my mind, if I need more than a 25% margin of safety, there's probably too much risk and I go find another company. Okay, the next sector we're looking at is consumer discretionary. Now, I have 5 companies from the consumer discretionary in my bullpen. Now, interestingly, consumer discretionary is typically the type of company that sort of moves with the economy. If the economy struggles, these types of companies tend to struggle as well. But some of these companies, in fact, most of them, are exceptions to sort of the industry norm. Because you take a company like AutoZone. Well, if the economy struggles, if the economy goes into a recession, well, consumer discretion, a company like AutoZone will do, a bit. It tends to do fairly well. In fact, we've done studies in the past, done videos in the past about companies that have done well during recessions. AutoZone tends to be one of those companies. Home Depot, Lowe's, right in line with that. Amazon, also in line with that, which might partially explain why all of these companies appear to be overvalued right now. By the way, if you're curious, the fair value for all of these companies, well, most of them in the bullpen, I'll get to an exception in a minute, but all of these companies and the previous ones are valued using discounted free cash flow. These, the bottom four here, well, they are a bit more defensive in nature, which would explain partially why the stock has popped a little as recessionary fears have been lingering for a while now. Alibaba, by the way, the only company on this list of five that I personally own, is a little bit of an exception in that, they've got a lot of different scenarios for them and against them. And as you can see, I got my highest margin of safety at 25% there. I have averaged down Alibaba a couple times. I'm not too interested in averaging down anymore just because I'm not sure I need any additional exposure to these types to a Chinese-based company, given my current portfolio. But overall, the other four, I'd be real interested in buying if the price got to be the right price. Okay, our next sector is the financial sector. Now, the financial sector in my bullpen only actually has four companies in it versus five in the other first two sectors. But here, I recently bought PayPal. You might have seen that if you saw one of our recent videos. I talked about buying PayPal in the future. I just recently bought it. I took a half position and actually paired that half position with Citigroup that I also already bought. This is the exception I was talking about as far as discounted cash flow. All the other companies in the bullpen are valued using discounted cash flow. But Citigroup was valued using price to tangible book value, just because discounted free cash flow tends not to work nearly as well for financial stocks. Some stocks it can work with, but not nearly as well for a pure bank like a Citigroup. So those two stocks look fairly undervalued at this point. That's why I just recently came into PayPal like a week or two ago. And Citigroup, I also came in on, although Citigroup was a little bit different because they've struggled with growth over the past decade or so. And the anticipation is they come up with a new plan, how they're going to ramp up growth over let's say, the next decade. And I'm anticipating that the stock will recover nicely because of that, assuming they can implement it. But again, that's why that company here has the highest margin of safety on the list, because I recognize that there's risk that they don't pull off their plan. And because of that, I only took a half position. I paired it off with PayPal because they're kind of complementary types of companies, both in the financial sector. And I wanted a little bit more exposure to this sector. Okay, the next sector we got is healthcare. And this sector only has one company in it, and that's CVS. Although I could easily argue that Walgreens Boots Alliance, WBA, should also be in this one, but I actually bought a half position in CVS as well. And the reason I ended up going with CVS over WBA was they had just acquired Aetna. And Aetna, the insurance company, I thought that was a nice complementary pair. So I think that I need a bit more exposure. I need more companies for the healthcare industry in general. The healthcare industry tends to be a fairly defensive industry. A lot of these companies are going to be overvalued. But if you know of any good companies in the healthcare sectors that I should do a deep dive on, please let me know in the comments below. I should probably do a deep dive on Walgreens Boots Alliance again, just to see if it does truly belong here. At the time, I only picked CVS when I analyzed the two of them, but it was because I liked the acquisition. But like I said, I have a small position in this one. If the stock continues to pull back, I might consider averaging down a little bit in this stock, but I'd really like to find something else in the healthcare sector. So I like this one. I like CVS. I like their long-term potential, but it could take a while to play out. Okay, the next sector we've got is the industrial sector. The industrial sector also only has one company in it, and that one company is killing me. That is Atcor. Now, Atcor, we researched Adcore in the investment community, in our private investment community. We researched Adcore and I said I really liked it. I go through the research process, say I really like it. At the time, the stock was like 100, 110, something like that. So, given that the fair value is up at 189, it looks really good. But I have the rule that I won't release a video. I won't buy a stock unless I first release a video on YouTube on it. And yeah, I still haven't done that video. So I haven't had the opportunity to buy it. And it's killing me because the stock's all the way up near the ideal entry right now. Now, Adcore I really liked. It's an electrical supply company. The fair value looks pretty good. And I had a 20% margin of safety, but I only did a 20% margin of safety because it was a smaller company. And smaller companies have different risks than a stock like Alphabet would have. So I increased the margin of safety a bit on that end. So that wasn't necessarily a risk of the business, more of a risk of their size. But I'm going to need this one to pull back. I've got to get this video done so I can say I might want to buy this one and explain to everybody why I give people a shot to look at it. Okay, now we're shifting over to information technology. We got 3 companies in the information technology sector in my bullpen, and I actually own all 3 of these. Again, just like the first sector that we looked at, all of these pulled back, and I was very excited about jumping in. Specifically, Microsoft and Apple, where I see them having, both of those companies having very large moats, very solid businesses. And I was so excited when the stock dropped below the ideal entry. I jumped in as quickly as I could. Intel's, a lot of people bust my chops on this one. Undoubtedly, Intel is more of a longer play. And I actually had a higher margin of safety for Intel before. Right now it's 15%. I think it was 20, 25% before that. But then they started rolling out all the information about them building new plants and all of that stuff. And I was like, oh, good. They got rid of their CEO. They brought in the new CEO. And I was like, good. This is right in line with what I was hoping they would do. So I lowered my margin of safety. That being said, all of these stocks at the current prices look a bit overvalued. So I've hesitated to average down too much. Actually, I can't average down because the price is too high. But if specifically Microsoft and Apple, if they ever drop below the ideal entry, I almost certainly will jump in and buy more of these and bring down my average price. Okay, next up, we've got the materials sector. We've only got one company in the materials sector as well, and this company is Celanese. This is another small cap company. There's a chemical company. Did the research with the community. I like the company. It looked good. We added it to the bullpen. Now we just needed to drop below our ideal entry price in order for us to jump in and buy it. Now, I do know some people in the community did buy it because I believe the stock was down at like 80 or so at the time. But I didn't go much further because I wanted to analyze some other competitors in the same sector, since this was the first chemicals company I had researched in a while. And I like to analyze a few companies in the industry to make sure I truly understand it. So this one, I need to pull back a little bit, but at some point you can expect to see a deep dive on this company. So that's the full list of companies in my bullpen. Now I'm always looking for new ideas, good investment opportunities. If you happen to know any, please let me know in the comments below. If you own any of these or are thinking about buying any of these, please let me know where you bought it. What's your average price? We can, compare where we bought the different stocks and what's your investment thesis behind it. I'd be real curious to hear what people think about the different companies. That's the beautiful part about sharing your ideas, is that you get to hear perspectives other than your own, which can be really helpful at times. Now, if you'd like to see the video on my full portfolio, I'll leave a link right here, link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.